Hello, welcome back. So in today's video, I'll be covering the deep value companies that have been beaten down lately. And for reference, this is my portfolio. Amongst all these companies here, I own one company that I feel is deep value now, and this company is United Health. So for our healthcare insurance companies, they've been beaten down by quite a fair bit over the past year. So for example, Canteen, United Health, Elevance, Humana, all of them are down over 40% in just the past 1 year. And historically, if you were to look at all these insurance companies and their historical performance relative to the S&P 500, a lot of them were outperforming the S&P 500 before 2024 started. So before 2024 started, you saw Humana beating the S&P 500. Elevance was ahead of the S&P 500 as well as United Health, of course. But in the past 1 year, all of them have dropped around 50%. So for insurance companies in general, they are often categorized into two categories. So you have your short tail companies as well as your long tail companies. So your short tail insurance companies, what they tend to do is they'll issue out basically short-term insurance, which is what all your healthcare insurance do. Whereas your long-term insurance companies, they issue out insurance that span over 10 years. Those are your property and casualty insurance companies. So for your healthcare companies, your healthcare insurance companies, they're often short tail companies. So for your short tail companies, what they tend to do, what they are able to do is, if let's say this year the cost is extremely high, the next year they can revise their prices higher. So for all these different insurance companies in your healthcare sector, what they can do next year is they can hike up the prices to make up for the cost that they missed out this year. So for your insurance companies next year, a lot of them are basically increasing their prices, they're raising their premiums. So under the ACA segment, which is the privatized insurance segment, they're planning to increase their prices by upwards of 15% in 2026. In fact, a lot of them have already issued upwards of 20% increases. So for example, Blue Anthem, which is Elevance Health, they have increased the prices, or they have called for increases of upwards of 22%. So that is a massive hike up in your prices, and that is to make up for the margin compression over the past few years for all these insurance companies. So for your insurance companies, as we covered earlier, more than a quarter of them are proposing premium increases of 20% or more for 2026. In recent years, premium in this market has relatively been flat or grown modestly for several years. Last year, just 3% of insurers increased premiums by 20% or so. No insurers have requested rate decreases for 2026, whereas in recent years, at least some of them reduced their premiums. So a lot of them, they're planning to jerk up their prices, and if that happens, then you can see some form of margin expansion for these companies as well. So for your valuation for all these healthcare companies, they've seen a lot of multiple contraction. So a lot of them in the years leading up to around 2024 were trading at around 20 times earnings. In fact, United Health traded at 20 to 25 times earnings. Elevance was trading at around 18 times earnings. And you had Humana that was trading at around 20 times earnings as well. But all these companies, they're now trading at around single digit PE or close to single digit PE. So United Health is trading at 12 times earnings. Elevance Health, adjusted for this year's EPS guide, is trading at around 10 times earnings. Humana is also trading at around 15 times earnings. So all of these companies that are hated by Wall Street right now, they're seeing a lot of multiple contraction, and that is what could be interesting in the years ahead. So in summary, these are your deep value plays that the market hits right now. Medicaid was worse than expected, so the big beautiful bill, it came out, and the Medicaid cost cutting was a lot more than what the streets were expecting. They work as deep value plays, but be aware of the risk when it comes to all these different companies. Try and limit the exposure, don't overexpose yourself. But for these companies, they're definitely deep value plays that you can look at right now in this overvalued market. So besides your healthcare companies, there are also other deep value plays in the market right now. The first company that I'll be talking about is LVMH, of course. LVMH year to date is down around 25%. It is currently trading at an 18 times earnings. So for LVMH, you're not just buying that Louis Vuitton company, you're owning all these different companies here, and it is basically a conglomerate at this point. So you have companies like Dior, Tag Heuer, Sephora, Loro Piana, all these different companies that are under this one name, which is LVMH. And if you buy the ticker, you're basically buying a Berkshire Hathaway of luxury. So for your luxury sector, it is projected to grow at around 2 to 4% over the next 2 years. And we're expecting around 4 to 6% growth in your leather goods and jewelry segment as well. So for LVMH, they have majority of their revenue coming in from the leather and goods sector. So if the company can resume back to growth this year, then you can expect around 5 to 6% growth for LVMH. And for LVMH, it has historically traded at a premium valuation. So this company has often been seen as a high quality company by Wall Street, and currently now is trading at an 18 times earnings. So relative to its history, the company is trading at a discount. And for LVMH, it's a high quality company that owns real estate, It's a top 3 company in its sector, so they own a lot of the stores that they sell their products in, and a lot of the real estate actually hold a lot of value. So buying LVMH today is like buying Berkshire in luxury, just hold and compound continually with Bernard Arnault's capital allocation skills. So Bernard Arnault is planning to stay in the company for the next 10 years, and for the next 10 years, I expect LVMH to do very well as well. The next company that I'll be talking about is Canadian National Railway. So this company is a very boring company that is currently trading at a 19 times earnings with a dividend yield of around 2.6%. So for this company over the past 5 years, it's been flat. So for this company, it is not your high-tech, high-growth company. It is an extremely boring business, but an extremely predictable, boring business. So for railway companies, they're extremely predictable because you have high barriers to entry. There's significant cost needed to basically build out all the rails and the infrastructure, and no company is willing to put in so much money because it's not cost effective for them to do so. And then for your railways, they are often cheaper than trucking as well as freight, so they will never go away, and they will always remain the most cost effective in North America. So for Canadian National Railway, it is not a company that is flashy. It's a company that will give you around 10% returns over the next few years. So the EPS forecast over the next few years is quite positive. In fact, over the next few years, the company is projected to grow its EPS at around 10%. So the company has historically traded at around 22 times earnings. So currently at the 19 times earnings, I think the company is cheap relative to its historical valuation. So if we're able to see some pricing increases with inflation, as well as some volume increases, and some buybacks here and there, around 2 to 3%, you can get around 10% returns from this company, 10% stable returns. And for a high quality, predictable business like Canadian National Railway, I think it is providing a decent opportunity right now. Although I'm waiting out, I'm still waiting for this company to be extremely undervalued so that I can try and outperform the S&P 500 holding on to this company. The next stock that is quite interesting as well is Adobe. So Adobe year to date is down around 17%. It is currently trading at a 23 times earnings. So for Adobe, the company is just cheap. The price to free cash flow right now is at a 16 times. If you were to adjust for stock-based comp, the company is trading at around 20 times earnings. So at its current price, you're not pricing in a lot of growth in terms of the free cash flow, maybe around 7 to 8% over the next 5 years. So for Adobe, I think it is one of the cheapest software companies out there right now. And the problem with Adobe today is simply just the AI story. So for Adobe, it is facing competition with AI. We don't know how many casuals use their products. So if the percentage of your professionals are a lot higher than your casuals, your professionals, they won't simply switch because there's AI, whereas your casuals, they can switch to alternatives like Figma and Canva, and they can also switch to Gen AI or video alternatives. So for Adobe, they don't release this number, so it's a bit hard for you to ascertain whether or not the company's consumer base is sticky. So for Adobe, it is currently a company that is facing competition. I think it is in a similar boat to Google. The metrics look incredible, the fundamentals are immense, but the problem with the company is simply just the story, which I don't like. So for Adobe, I'm still looking out for this one. The company is cheap, but hopefully it gets a lot cheaper so that there's that margin of safety for you to look into this stock. The next company that I'll be talking about is Copart. So Copart year to date is down around 18%. It is currently trading at a 30 times earnings. So for this company, I have an investment thesis right up here. So this is what Copart does. Copart operates an online car auctioning platform, collecting fees with every transaction made on their platform. Copart has 3 main business lines. They have their services revenue, they have their international revenue, as well as their vehicle sales. So the services is the majority of the revenue. Basically what they do is they collect fees from every transaction. They collect membership fees, they collect cleaning fees, they collect towing fees, and so on. So for Copart, they're basically an Amazon for your cars in the US. So they provide a platform for bidders to come in and buy salvage cars, and for sellers, which are your insurance companies, to sell their salvage cars. So when insurance companies deem the repair cost of the car greater than the actual car price, the car is under total loss. And when that happens, your insurance companies, they'll basically send the car to Copart, who stores, lists, and markets them in their online auctions, and then Copart will collect a fee of the total transaction cost. So for Copart, here are the main metrics that you need to look out for as well. So for number 1 is obviously the total loss frequency. So your total loss frequency refers to the percentage of cars that can be declared a total loss by an insurance company after an accident. So currently it's at around 22%, and it has been steadily growing over the past few years because a lot of your cars are increasing in terms of the technology. And when that happens, your repair costs will go up. So when repair costs go up and when there's urbanization, when more people move to the cities, there'll be more accidents happening, and so there'll be a higher frequency of your total loss. Besides that, there's also your miles driven. So when your cars are driven longer, the likelihood of accidents is higher. And then There's another metric that you need to look out for as well, which is your average car age. So when your cars get older, obviously they're getting driven more. So that again leads to more accidents, which helps Copart. So for Copart, the main risk that you need to look out for the company are two different things. The first one is the concentration of your insurance companies. So for Copart as well as the competitor, which is IAA, they have 80% of their cars coming in from insurance companies. So they are concentrated in a lot of your insurance companies here like Geico, State Farm, Progressive. In fact, recently, IAA managed to increase their volumes from Progressive, which led to a decrease in volumes for Copart. So that's a problem when it comes to your insurance companies. They're highly concentrated in all these insurance companies. They need to make sure that they maintain a good relationships with your insurance companies. And besides that, the other major risk for the company is your robo-taxis. So when you have companies like Tesla and Waymo coming up with automotive vehicles, that could be a long-term terminal risk for the company, because when you have more robo-taxis on the road, it will lead to less accidents because your robo-taxis, they are a lot more skilled than normal human beings. They are normally a lot less prone to human errors. So for Copart, that is a terminal risk for the company that you need to make sure you are aware of. But my view is that this AV risk is a lot more overblown than expected. I think companies that will be affected immediately include Uber, not so much a company like Copart. Even if AVs go on the road, the adoption rate will be low. It will probably take another 20 years for all these AV cars to come on the road, especially with regulation. And so for AV cars, I don't think it is an immediate risk for the company. As the company's management has suggested, it is a lot more overblown than expected. So for now, I don't think this is a big risk for the company. So for Copart, I think it's an interesting company right now. It is currently trading at a 30 times earnings. I'll be continually researching this one. And if it provides a decent buying opportunity over the next few months, I will probably look into this company even more. The last portion that I'll be covering are some of the comments left in the comment section. So the first one, it says, what is your opinion on Adobe, Novo Nordisk, Nike, as well as Alibaba? So for Adobe, we've covered it earlier. The company is fundamentally sound, but the problem is the story. For Novo Nordisk, the company is definitely cheap now. If you're an expert in the healthcare sector and you have an edge, then I think Novo Nordisk is a company that looks interesting right now, especially for the growth in the years ahead. But for me, I'll be avoiding this name because the company is simply just too complex. For Nike, I think it is a company that is not predictable enough. Retail is normally a very hard business to be in, and for Nike, they have a lot of competitors. So you have competitors like Adidas, you have other competitors in other segments as well, like Lululemon. As for Alibaba, it is a company that is cheap in the short term. You will likely get good returns in the short term, but in the long term, I'm not too sure about this company as well. So for Alibaba, it operates your online retail segment. And the problem with that is a lot of your online retail companies in China, they're lowering their prices. And when they try and lower prices to gain market share, what happens is it leads to a tit for tat. So all your companies, they will lower prices together. So they'll squeeze each other out of margins, which is long term not a good thing for all your companies in the same space. So for Alibaba, as well as JD, as well as PDD, all these companies, they are lowering their profit margins, which is overall not a good thing in this sector. And that's why Alibaba is not a long-term hold for me. I think it is a company that I'll look to invest for the short term, but definitely not for the long term. The next question, it says, how often do you sell your underperforming stocks? So typically when I consider selling my stocks, I only sell my stocks when the thesis has changed. But the company's fundamentals are getting weaker. So in the case of Google, for example, over the past 12 months, the company has been underperforming, but I haven't sold a single share in the company. And in fact, I've been buying on the way down. My last purchase was at around $148 a share. So my principle is that I only sell companies if my thesis change. So I prefer sticking to the method of selling companies only if the thesis change or only if the fundamentals have changed. I hope you guys have found this one useful and invest safe.